Hey guys,
Ooh, good morning.
how's it going?
I'm caffeinated today, so
Nice.
things are looking up.
Well, I have some bad news. Due to technical difficulties, I did not have time to look at my thesaurus. So,
Shooting from the hip today?
no, I'm gonna
No,
keep the
no.
powder dry, such as it were. How are you doing, Dean? I can't hear you. Are you muted?
Yeah, Dean, we can't hear you. It's brutal.
I'm on.
Oh,
No,
there he is.
yay.
I was just reading up on the big sales week next week with Amazon Prime Day, Walmart's Big Save Day, and Target's Deal Day all happening next week at the same time. It'll be a big week.
Yeah, I was having an industry conversation. I can't disclose kind of the source, but the basic gist of it was: do they know what they've done? Put Prime Day and Black Friday within essentially a month and a week of each other.
Yeah. Yeah, they're offering, Black Friday level sales. Target are offering drive up, sort of deals, same day delivery. It's going to be a crazy week next week, but that should flatten out some of that peak shipping volumes we typically talk about.
Yeah, but does it flatten out at a super high plateau? Is the question.
Exactly.
Yeah.
Yeah.
Hey,
The
the other
old
big
Tibetan plateau of rates.
I was looking right before we joined live. This hurricane's going to be gnarly.
Yeah. Yeah, it's got
Delta,
plenty of fun
is it?
across the Gulf.
Delta, yeah, they're
Yeah.
predicting like a Category 4 when it hits the Yucatan, and then spilling into the Gulf of Mexico is a 3 or a 4.
Yeah.
So that area of the Gulf has just been hit. I mean, thankfully nothing, major, but it's just been kind of hit over and over and over again this year.
Yeah.
Yeah, the last few storms, NOAA was sort of indicating that the last few storms maintained intensity right up to and including landfall, which was kind of unprecedented. Normally they weaken as they get closer and the water gets shallower, but not in the last three, they were saying. Much more intense across landfall.
Yeah, I mean, what comes after Delta? That should have been our trivia question for the day.
Epsilon.
I'm impressed.
How many more are left?
Quite a few. I can't do the whole Greek alphabet. I could recognize the characters, but I can't do them all in order. Alpha, beta, gamma, delta, epsilon. I used to be able to do it. Eta, beta, pi.
Well,
all right. We're getting the signal from the producer.
I will jump us into content for that week. You guys good with that?
Let's go.
All right. So welcome everyone to our live DATIQ weekly market update. This is our update for October 6, 2020. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist. It just didn't feel right, Ned. I need to put a superlative in there. And I'm also joined by Dean Croak, who's our Principal Industry Analyst. Welcome, guys.
Hey.
Howdy.
All right. So we have a lot to cover this week with everything going on. So I'm going to jump in to our key points. So I think most people felt it, even if they didn't look at the calendar, but we just came through end of month and end of quarter, which pushes volume up as well as rates. So we saw total load post volume up about 5% week over week and more than double 2019. Now that's spot volume, right? That's volume on our load board. That's not indicative of the total spot and contract volume for hire. So both load and truck posts were close to 18% compared to October 17. But the difference is this is mainly retail consumer driven, then it was more industrial driven. Lastly, fourth quarter is looking good, but what happens in Q1 and Q2 of next year? So to help answer some of those questions, I'm going to turn it over to Dean for the market dynamics and rate trends. Dean?
Let's start off with the load to truck ratio for dry van. This week it tracked very closely to 2017, as you can see from the red line on the chart. There was about a 6% increase in the load to truck ratio from 5.56 loads per truck. Load post volumes increased about 6% last week. They're now more than double where they were in 2017, which reflects the unprecedented spot volumes that we're seeing. As Ken mentioned, end of month, end of quarter, big factors in last week's increase. FMIC colleagues tell us that high rejection rates still persist in the contract freight market. So any surge volume late last week will have shifted over to the spot market quickly. Same thing was evident in the reefer load to truck ratio. Volumes were up last week about 10% week over week. That moved the load to truck ratio up 18% to 10.63. Of note, last week, grocery and food companies have been prepping for a surge in winter COVID cases. On a call last week, they were talking about accelerating production, stockpiling goods. Some people in the fresh and frozen food space started talking about Thanksgiving in June, began stocking hams and turkeys a lot earlier than they typically do. Frozen turkeys ship pretty much all year round, but we could see some higher volumes sooner than we normally do, which is typically about 3 weeks out from Thanksgiving when fresh turkeys start. But as always, capacity will be very tight in the Midwestern markets up through Joplin and Northwest Arkansas. Moving over to the flatbed market, the load to truck ratio increased last week, about 8% up to 45. Outbound load post increased another 3% last week. Fewer trucks were searching for loads. The LTR for flatbeds about 1.5% higher than it was in 2017. Onto the market condition index for dry van, we still see a lot of capacity tightness and higher spot volumes in the market week over week. This week, what was noticeable was our coastal seaport load volumes, which tend to mirror import-export volumes. And given we've had such a strong surge in e-commerce freight from Asia in particular, as retailers have been replenishing their inventories, what I noticed last week that after 3 successive weeks of gains, volumes in Los Angeles, Ontario were down 7% week over week, but capacity was still tight. Rates are up 2 cents to $3.02 a mile. Further north in Seattle, another big port, volumes were down 9% week over week. On the East Coast in Savannah, volumes were down 3%. Further north in Baltimore, volumes were down 12%, and that's significant for flatbed carriers. That's a big machinery roll-on, roll-off port. Further north in Elizabeth, New Jersey, which is our #1 import port on the East Coast, volumes are down 12% week over week and are now down 18% month over month. In the Southwest, volumes have been very flat in Houston. But when we look at the top 10 coastal ports, these are seaports like Seattle, Savannah, Charleston, Baltimore, Los Angeles, outbound load post volumes are down 6% week over week, definite slowing. But in contrast, capacity is still tight because rates were up 7 cents per mile to an average of $2.44 across all of our seaports. On the refrigerated side, we can still see evidence of the tail end of the produce season. We're well past the June peak. Volumes are down 24% year over year. Offsetting that, as we've talked about in recent weeks, was higher refrigerated foods like dough and other frozen foods. Volumes in the Pacific Northwest, as you can see in the top left of the chart, still pretty good. In Spokane, Medford, Seattle, Twin Falls, Pendleton, what I class as the Pacific Northwest reefer market. Those volumes cooled 8% week over week. They're now down 25% month over month, so a definite slowing in fall produce volumes. Further south, you can still see some activity around Ontario and Fresno. Grapes are the #1 fall season harvest. Those volumes are peaking, and they drove volumes up 3% week over week. Reefer capacity in Ontario is still tight. Rates are up 2 cents to $3.07 a mile. And a big surprise this week, we rarely talk about the New England market because it's such a strong inbound market and a backhaul market for carriers. But last week, reefer volumes were up 18% week over week, and outbound rates for reefers were up 17 cents a mile to $1.97. So you really know capacity is tight when it's hard to find reefers in Boston. Onto our flatbed market condition index. Manufacturing news is good. The ISM manufacturing PMI up for the 5th month in a row. So we're still seeing some good activity, not fully recovered in manufacturing, but some good signs. Still a lot of market imbalance. And there's a question we had last week about why we see so much red on our MCI. Typically in flatbed, flatbed carriers typically haul a lot more one-off project-related freight. They spend more time under cranes, live loading, unloading. They run more deadhead miles. And compared to the dry van sectors, they have fewer backhaul opportunities. So that's why you see so much market imbalance in terms of supply and demand. Some interesting trends in our #1 market, which is Memphis, for load post volumes. They contribute about 5% of our total volume each week. Volumes are down 8% after 4 weeks of successive gains. Rates were down 9 cents a mile to $2.70 out of Memphis. In our other big notable market in the Southwest, in Alabama, Decatur, Birmingham, Montgomery, which contributes about 8% of our weekly load post, volumes were down 12% last week. Rates were also down 5 cents to $2.96 a mile. A little bit different story in the Southwest, a little bit more activity in Texas, Dallas, Fort Worth, San Antonio, Houston. Volumes are up 8% in the state of Texas, up for the third week in a row in rates. Dallas, Fort Worth capacity was a little bit tighter for flatbeds. Rates were up 4 cents a mile to $2.19. So moving over to our final wrap-up for the week, we're looking at the year-over-year dry van spot rates. Last week, we talked about a slowdown in the rate of increase for dry vans. That changed last week with end of month, end of quarter. Volume spiked up again to $2.27. They're now up close to $1 a mile, excluding fuel surcharge, since May the 1st, when we had the low point in the pandemic. $1 a mile since May the 1st. It's staggering. Rates are up about 48% year over year. This time last year, they were $1.53 a mile. Capacity is still tight in most markets, although volumes typically ease at the start of the first week of the quarter and shipping month. As we talked about at the top of the show, the e-commerce sales weeks next week for the big box retailers could drive up volumes again this week, but we'll know more later. In the reefer side, on the spot rate side, definite plateau through September, but that changed last week. Rates moved up again to $2.39 a mile. Rates are 32% higher year over year, and they're now just 2 cents shy of the record that was set in 2018. A couple of markets that I looked at this week. Joliet's our number 6 market in terms of reefer volumes. They were up 19% week over week. Rates are up 5 cents to $3.16 outbound from Joliet. And our number 10 market, which is Columbus, Ohio, for outbound load post, volumes are up 24% and rates spiked 19 cents a mile to $2.88 outbound Columbus. On the flatbed side, rates are higher again, moving up to $2.23 a mile. They're now 38 cents a mile higher than this time last year. But there are signs this sector is definitely cooling based on data coming out of the flatbed markets we just covered in Birmingham and Tennessee. So that's the update for this week, Ned, on the supply and demand side. Over to you for the rate forecast.
Before we do the rate forecast, there is a very important update that we have, and that is Rate Watch 2020, the Halloween-related bet.
Right.
Monica, can you cue the clip?
Right.
If I can interest you folks in a wager, and that is a Price is Right style. Where do you think dry van rates will be before Halloween? And those that lose will be dressed up in appropriate Halloween-y costumes.
I'm in.
Yeah, I'm in.
All right.
I'm in.
Dean, do you want to go first?
I'm thinking by October 26 down to 210.
I'm going to shoot for 230 a mile.
Yeah, just for kind of symmetry, I think I'm probably going to go in at 220 a mile.
And remember, it's Price is Right rules. Closest without going over the actual rate.
Huh.
Yeah. So
I never
right
caught
now,
the Halloween-y thing when you said it, but I feel like I'm going to have to hold on to that one for future reference.
I mean, come on. I'm dressed up as a businessman because I'm wearing a tie today. Miss me with that. Come on. Come on.
I went as a corporate lackey for the better part of a decade at FedEx.
At DAT,
Who's winning, Ned?
Currently, who is winning is you, Ken. My goodness. How does that work out? It's 227 a mile right now, as Dean said. If you look at the green line, Ratecast is projecting a little bit of a plateau followed by a dip. But I would say that during the pandemic, Ratecast has tended to undershoot slightly in my defense, although the accuracy it's maintained has still been 95%, so I will take it. I'm feeling good about my odds. Ken?
Yeah, I mean, I'd really say that carriers are winning in this, truthfully.
Oh, yeah.
We look at shippers, carriers, and brokers as proxies for the three of us. I think we'd all agree that the carriers are the ones winning with these current rates.
Especially when you see backhaul markets like Boston get very tight. I rarely see that.
Yeah. I mean, it'll be interesting to see what plays out in the fourth quarter. So we're guessing, and one of our slogans here at DATIQ is don't guess, know. Mm-hmm. Can you help us out, Ned, and put some science behind this thing?
Well, like I said, the Ratecast forecast is what we're going to be talking about now. So here is the chart of dry van forecast. So you can see the blue line are the historical rates observed by DAT, the market rates observed by DAT. And then off to the right, you can see our spaghetti, the different models that we have in-house. Green is the Ratecast model, which was shown in the graph for the Rate Watch. And there you can see Ratecast is expecting a little bit of a plateau and then a slight dip downwards, whereas the short term is expecting a continued up into the right pattern. And then the blended forecasts are laying in the middle, staying at about 230 a mile going through October 26th and into early November. Moving on to the reefer rates. The reefer rates, again, the blue line is the historical market rates observed by DAT. And then off to the right, you can see the models. Here, there's a little bit more model agreement early, but there's, again, a little bit of model divergence, although not quite as sharply as you're going to see in flatbed. The Ratecast model is expecting a little bit of a plateau and then a dip. I'm going to probably wear myself hoarse saying the same thing over, while the short-term model is expecting more up and to the right, and then the blended forecasts are in the middle, although tending a little bit closer towards the short-term model, at least for the near future. Finally, we're into flatbeds. Again, the blue line is the historical market rate observed by DAT, and then we have a very sharp model divergence. The short-term model is expecting strong up and to the right, whereas the Ratecast model is expecting basically a correction. I think it's going to be interesting to see what happens going forward. There's definitely signs that there might be a correction in the flatbed market, but then again, given how bright red the MCI graph has been, I think it'll be interesting going forward. I think that's about it for the rate forecasts, and it's time to move on to the question of the week. And for the question of the week, I hope that you all have your slap bass ready and are wearing your Jinkos, because we're going back to the 90s with the question, what's the deal with contract rates?
Thanks, Jerry. I mean, Ned. We have one of my favorite charts of all time to display. This was my money chart when I was presenting at the Memphis startup that I worked at prior to DAT. So we're going to get that up on the screen here in a second. Need some elevator music. Anyway, I'll level set what we're about to show. So we're going to show two lines. So the blue line is contract rates, so shipper to carrier contract. The orange line is spot rates, so broker to carrier spot. And then that gray bar is just the difference. So I think that helps illustrate, sometimes the absolute difference between those two lines is hard to see. So the bar helps. So what you're really seeing is, 2018 was the last real time period where we saw this flip occur. So when the bars go negative and spot rates are above contract. But we're currently at a point where I had to move the axis down, right, because spot rates are so far above contract. But that I don't want to draw that sometimes draws attention away from the fact that contract rates are up, and they've been on quite a rally. They're just not; they don't move as fast as spot rates. Mm-hmm. There's a couple of reasons, and I'm going to turn it over to Ned and Dean for some additional color. But a couple of the main suppositions we have from talking to folks as well as looking at the data. The first is routing guide slippage can drive rates up even if freight's not falling off. And what I mean by that is a carrier that's second or third or fourth on a routing guide is there for a reason. They're usually more expensive than the first or second. So if the first and second carrier isn't taking as much of the freight and it's slipping down to the third, fourth, and fifth, if you have that many, rates will kind of tick up, even though those are the same paper rates from a while ago. There's no doubt we're seeing rates being backfilled with more expensive rates, but it's kind of an amalgamation of all of these things that are pushing contract rates up. What kind of stuff are you guys seeing, Ned and Dean?
Similar effect. I think what's interesting here is that the capacity has tightened much quicker than most people expected, because we if you look back to that 2018 period, what we were used to was like a 40 cents per mile increase, but that was over a period of 9 to 12 months. Here, the difference is that capacity has tightened so quickly. We've seen a dramatic increase in spot rates, but it seems to be dragging up contract rates much quicker than normally. And I think that speaks to the capacity tightness that we're seeing as carriers barely, I think, honour their contract volumes. We're seeing a lot of that surge volume, particularly around end of quarter, end of week last week, flip over the spot market and drive volumes up. But that's been the case for the last 4 or 5 months, where carriers are still talking about their equipment not being in position. and their deadhead miles being double and treble what they would normally be. So they're doing more miles, but having to run more miles between loads because loads aren't typically where they would normally be. So it points to a continuation of this trend, certainly in the short term.
I'm interested to what extent that contract rates are becoming more responsive due to the patterns that Chris talked about when he was on the show, where he was talking about switching from doing like an annual contracting process to doing a more short-term mini bid process. And I feel like to the extent that people are adopting the mini bid as more of the gold standard, or even more abstruse technologies like indexed contract rates, I think that you're going to see contract get to be more responsive. And I think that's going to be helpful to make sure that you don't see that routing guide slippage. But it is to the extent to which it's being honored and people are respecting those technologies, I think you're going to see contract rates becoming more responsive.
I wonder how much, Ned, though, that's actually happening right now. There's no doubt that mini bids happen.
Right.
I just wonder if the noise that we're hearing about mini bids is far disproportionate to the amount of times it's actually happening.
I mean, I think you're right. I don't think that the technology is widespread, but I do think that I mean, although Chris Kaplis was a little bit hyperbolic in his claims that like if you're not making mini bids, you're doing something wrong. I think that you can absolutely make reasonable annual bids, but I think in a market like this where there's just so much uncertainty and so much going on, I think shortening the horizon for your contract is really just a safe move for everybody because nobody wants to be caught out in really unfavorable conditions.
Don't you think, though, like if you look at the new truck orders, which are a reflection of what's going to come onto the market next June, say, right? Typically orders come in this time of the year for 6 to 9 months before they come out of the factories. If the manufacturing plants are increasing the number of slots for building things, then the contract carriers, in particular the large ones placing orders, have a fairly positive view of where capacity will be next year. So it feels like there'll be more capacity coming into the market. But as Ken suggested this week, if contract rates keep moving up, then at some point capacity should start to enter the market again. And the market should return to more of an equilibrium. But that all depends on consumer demand this time around, because we're not seeing the industrial volumes we would normally expect.
Yeah, I think it's magnitude and duration, obviously directionality, so whether they're up or down, but it's also magnitude and duration. And I think we're seeing a great magnitude right now. But I mean, just from the conversations I'm having, folks are a little reticent to believe that the current climate's here to stay. I mean, you're seeing it in a very anemic Class 8 truck orders. I mean, the numbers that just came out weren't groundbreaking by any means. And they haven't been for the better part of 2 years now, right? We haven't seen material influxes of capacity. That's not to say, now, I'm not making the bold call that capacity owners have learned to break a 40-year cycle of overbuying and then going out of business. But and maybe they're a little bit still snake bit from 2018 is, I guess, the overarching point I'm trying to make. And
they also had a pretty rough 2019, right, where we suffered from excess capacity and declining rates overall. So I think there's been some reticence to add back in capacity too quickly this time around.
To what extent do you think that capacity is going to be able? I know you're really hot to trot on that question, but to what extent do you think that capacity is going to be able to be made up by non-traditional trucks? So things like sprinter vans, box trucks, those kind of things. We've seen a real uptick of that kind of activity on the DAT load board, and I know normally that doesn't enter as much into people's pictures, but to the extent that that keeps growing, I think that's going to be really interesting.
I've seen a lot more demand for shorter haul, less than truckload deliveries in that sort of 100 to 150 mile radius. So I think that's going to be a growing market, Ned, where both people are delivering that hot shot in much smaller vehicles on a much shorter radius of haul. I think the other thing that will drive it up is, of course, in that expedited sector is the need to move vaccines around the country next year. I think that's going to drive up that sector in particular.
But that's
I think of that stuff as like the marginal unit of capacity. Right. I mean, most of everything else is going to be filled by your traditional capacity elements, whether that be truckload, intermodal, LTL. And then you have this marginal unit of capacity, which could be these sprinter vans or box trucks, that kind of stuff.
I hear you, but I guess it's less of a concern in right now or something that's happening right now, but kind of a future focused thing is for a long time to use like an economy perspective. Consumer demand was kind of the marginal unit of demand, right? Like things were primarily being driven by industrials, but as we're now in 2020 and the economy is more and more kind of consumer driven, it's less the marginal and more of the base load of the economy is coming from consumer demand rather than from industrial production or industrial demand, if that kind of makes sense. And if we're continuing into the future, if that market keeps growing, I'm just going to be interested to see how that's going to affect things.
Yeah, I mean, I guess that's a simpler question to answer, right? They're going to have to figure out the economics because at the end of the day, you get less per mile for a box trucks, and in a lot of cases, they're more expensive than a power unit. Mm-hmm. That's the one thing I never understood when I was in industry. It's like, why would you invest $300,000 in a 22-foot straight truck? And then the government changed the rules on the excise tax for the tag axle. Mm-hmm. So a lot of these people pulled their tag axle, and they can only haul like 5,500 pounds. It's drifted out of memory, but it's like 3,500 to 5,500 pounds. Yep. I mean, unless it's like subsidizing an RV lifestyle, there was really no reason to pursue that. Now, it rates at what they're probably getting right now, $3 a mile in the expedite side. Maybe it makes sense from an economic perspective, but they're going to have to find a way to flip those economics long term. We did have a question, Ned. Do you want to fire that one off?
Oh, absolutely. So it's from Josh Lumsden, a branch manager in Atlanta at a logistics company that I'm going to leave off right now out of concern for their privacy. Says the flatbed market is the worst that they've seen in years. Frowny face. What are you guys' thoughts on that? I mean, obviously he's coming from the broker side, but I mean, is it universally the case that good for carriers is bad for brokers?
I think if you're hauling lumber, you're having the opposite comment. If you're hauling coiled steel, that's probably what you're experiencing. But I think Dean would have probably a better perspective. Dean?
Oh, dear.
Yeah, I mean, I think flatbed, just in my experience, is a very industry-specific, like that. The trends follow industries much more than dry van, because I mean, you really don't care if it's reams of paper or I don't know, pallets of toilet paper back there. But with a flatbed, right, you could support the oil and gas industry, which you're starving right now. You could support the building materials industry, which is booming. You could support the steel, which like maybe like the steel in Midwest is largely supporting the automakers. So I just think it's probably industry specific. If you're a broker and you have the flexibility to branch out to customers supporting different different types of material, that might be a way to get better rates and find more volume. But right, because there's a lot of automakers in the Southeast now. A lot of people don't realize that, especially a lot of European auto manufacturers, European and Japanese, have really taken advantage of some of the tax benefits of moving to the Southeast. I know Volvo, Mercedes, BMW, Nissan has several gigantic plants in the Southeast. So they're not making as many cars right now. And so if that's the industry that you're supporting with your flatbed, it's probably going to be a little slow.
We're getting the signal to wrap from our producer, but I just have one more comment or one more question for you, Ken, about that. To what extent so something that I've heard anecdotally is that with flatbed, the experience in the driver matters a lot more because of the loading and the handling of the material than on the van side. To what extent do you think drivers can be easily retooled between hauling different kinds of things? And I really wish Dean was here to comment to that.
I mean, it's kind of like I think most flatbed, like experienced flatbed haulers, could go pick up a dry box, no problem. I think you're especially like if you're a company driver going dock to dock, drop and hook, given you've never chained or tarped or done any of that stuff, that's not what would you call it, like a fungible unit of capacity.
Right.
And then a lot of flatbed folks, especially if they're busy, they'd have no real reason to move into the dry van market and make less per mile. Now, we did see like a lot of seasonal, especially in the snow belt area. That flatbed's a hard job, pulling over every couple hundred miles. to check everything, and it's snowing and your chains are frozen. Some of those folks, especially as they get a little bit older and don't want to deal with that, they might switch if they have the luxury to be able to do that to kind of a drop and hook flatbed or reefer, route or job or whatever they can do.
Makes sense.
But I'm going to wrap us up. I'm getting the virtual shepherd's hook Ned alluded to. So even though Dean dropped off, he puts together an outstanding weekly written market update with tons of charts and graphs. I love pictures, so that's why I like it, but tons of great commentary. That's at dat.com/market update. AskIQ@dat.com if you didn't have your coffee this morning and still want to get a question in. But other than that, we'll be back next week. We will check in on what you call it, Ned, Rate-A-Rama.
Rate Watch 2020.
Rate Watch. All right. And anyone in the path of the hurricane, anyone in the path of the prospective hurricane, we encourage you to be safe, listen to your local authorities, and if they tell you to get out, please go ahead and get out. With that, have a great week, and we will see you next week.
Bye, y'all.